Nvidia reported an outstanding fourth quarter fiscal year 2026, with revenue reaching $68.1 billion, up 73% year-over-year, primarily driven by strong data center growth of 75%. Other segments, such as gaming and professional visualization, also recorded solid gains, though their contributions remained comparatively smaller. Operating income came in at $44.3 billion, representing a 65% operating margin, while net income reached $43 billion, translating to a 63% net margin, an exceptionally high level for the semiconductor industry. EPS was $1.62, slightly above market expectations, reinforcing confidence in Nvidia's continued momentum fueled by the AI wave. Revenue by segment further highlights how transformative the AI cycle has been for Nvidia. Over the past few years, data center revenue has expanded at a CAGR of 108%, dramatically reshaping the company's revenue mix. In Q4 FY26 alone, data center reached $62.3 billion, now accounting for the vast majority of total revenue. Meanwhile, gaming has remained relatively stable with modest growth, and other segments contributed incrementally. The sharp inflection beginning in FY24 clearly reflects the generative AI boom, which has become the primary structural growth driver for Nvidia's business. CapEx from the top hyperscalers, Amazon, Microsoft, Alphabet, Meta, and Oracle, is projected to surpass $650 billion in 2026, with roughly 75% allocated to AI infrastructure, reinforcing the structural scale of the AI build-out. This surge in spending is driving AI chip demand, with Nvidia as the primary beneficiary, supported by an estimated $500 billion AI backlog across 2025 to 2026, providing strong multi-year visibility. Broadcom also benefits from custom AI chips and networking, while AMD is expanding its AI accelerator and data center CPU presence, though both remain smaller beneficiaries compared to Nvidia. Nvidia is accelerating the next phase of AI infrastructure with the launch of the Rubin platform, targeting up to 10x lower inference costs, and Blackwell Ultra, delivering up to 50x performance gains for agentic AI. Major cloud providers, AWS, Google Cloud, Microsoft Azure, and Oracle, are preparing Rubin-based deployments, reinforcing hyperscaler commitment to Nvidia's roadmap. At the same time, strategic partnerships with Meta, Anthropic, CoreWeave, and leading enterprise software players deepen Nvidia's ecosystem advantage, extending its leadership across cloud, enterprise AI, scientific research, and industry-specific applications like drug discovery and weather modeling. Desktop discrete GPU shipments have moderated from prior cycle highs above 20 million units per quarter to the low teens millions in recent periods, reflecting post-pandemic normalization and softer PC demand. Despite this cyclical decline in unit volumes, Nvidia's market share has steadily expanded, rising from a mid-60% range a decade ago to above 90% in the latest quarters. This share gain highlights Nvidia's strong product positioning and brand dominance in the premium gaming segment. At the same time, as industry capital increasingly shifts toward AI infrastructure, Nvidia has successfully balanced both markets, maintaining leadership in desktop GPUs while redirecting strategic focus and wafer allocation toward higher growth, higher margin data center AI accelerators. Beyond data center, Nvidia's long-term growth is supported by three strategic pillars. In gaming and AI PC, full-year revenue reached a record $16 billion, driven by strong Blackwell demand. Nvidia DLSS 4.5 and RTX AI enhancements are delivering up to 3x performance gains and 35% faster AI inference on AI PCs. In professional visualization, revenue surged 159% year-over-year in Q4, supported by demand for the new RTX Pro 5000 Blackwell GPU and expanding DGX Spark deployments. Meanwhile, automotive and robotics generated $2.3 billion in full-year revenue, driven by NVIDIA Drive, physical AI platforms, and expanding partnerships with Mercedes-Benz, Siemens, and Dassault Systems, positioning Nvidia at the center of industrial AI and autonomous systems. FY 2027, FY 2028 mark Nvidia's transition from AI build-out to full AI scaling. FY 2027 focuses on the Rubin ramp and HBM4 transition, while FY 2028 scales Rubin Ultra, enabling up to 576 GPUs per rack, 15 exaflops of inference, and 365 terabytes of fast memory per rack. By 2028, the AI semiconductor market could reach around $159 billion, supported by expanding AI server demand and global data center capex that may approach $1.7 trillion by 2030. In the bull case, revenue growth could remain 25 to 35% in FY 2027 and 20 to 30% in FY 2028, with gross margins above 70%, contingent on Nvidia sustaining its performance leadership amid rising competition. Nvidia's operating expenses have increased alongside its rapid growth, with research and development spending expanding at a 38% CAGR, significantly faster than selling, general, and administrative expenses, which grew at around 21%. This reflects Nvidia's strategic focus on sustaining technology leadership across GPUs, AI systems, and software platforms. By Q4 FY26, research and development spending reached $5.5 billion, while selling, general, and administrative expenses were $1.3 billion, highlighting Nvidia's clear prioritization of innovation to support long-term AI leadership. Nvidia's net income has shown a strong upward trend, rising from $3 billion at the beginning of FY 2023 to $31.9 billion by Q4 FY 2026. This sharp increase reflects the powerful earnings expansion driven by the AI infrastructure cycle. At the same time, net profit margins have structurally improved, climbing from below 20% during the post-PC slowdown to stabilizing around the mid-50% range in recent quarters. Despite a brief dip in Q2 FY26, margins quickly recovered to about 56% by Q4 FY26, highlighting Nvidia's strong pricing power and operating leverage. From fiscal year 2023 through fiscal year 2026, Nvidia's revenue has expanded rapidly and has consistently tracked closely with market expectations, reflecting strong and sustained demand for AI infrastructure. Growth has been primarily driven by hyperscaler investments in AI data centers and the rapid adoption of Nvidia's data center GPU platforms. Consensus estimates suggest this momentum could continue, with quarterly revenue projected to reach roughly $100 to $110 billion by the end of fiscal year 2027, supported by ongoing AI cluster deployments, the ramp of the Blackwell platform, and the continued expansion of large-scale AI data centers. Earnings per share have followed a similar trajectory, rising sharply alongside revenue and generally meeting or slightly exceeding consensus expectations in recent quarters. Looking ahead, consensus forecasts suggest quarterly EPS could approach around $2.40 to $2.50 by the end of fiscal year 2027, reflecting continued revenue growth and sustained profitability, even as the company maintains elevated investments in next-generation AI chips, systems, and software platforms. While Nvidia continues to deliver exceptional revenue and earnings growth, its share price has recently traded within a consolidation range around $180, reflecting broader market volatility and periodic valuation adjustments across large-cap technology stocks. The pause in price momentum appears more related to market positioning and macro sentiment rather than any deterioration in the company's underlying fundamentals, as demand for AI infrastructure remains strong. Despite short-term market fluctuations, analyst sentiment remains overwhelmingly positive. Based on consensus from 71 analysts, the average 12-month price target stands at approximately $267, implying roughly 48% upside from the current price near $180. The bull case reaches $380, while the bear case is around $140, suggesting a favorable risk-reward profile. Analyst ratings continue to reflect a prevailing strong buy stance, underscoring institutional confidence in Nvidia's long-term leadership in the global AI infrastructure market. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or a recommendation.